All right, now we're going to get back to the RBA rate cut, but you've probably heard enough guff about it from us two pelicans. So now it's time to hear from an actual expert. And that's why I'm pleased to introduce one of Australia's foremost economists in Shane Oliver from AMP Capital. G'day, Shane. Welcome to the Savings Tip Jar.
Thanks, Dominic. Great to be here.
Thanks for coming on with us two bozos again, Shane. I think the last time you came on was episode 62. I believe this is episode 106. So just a bit's gone on in that time. You know, we were talking about the federal budget of last year, and now we're talking about the most recent RBA cut. There's been two now. But before we get into all that good stuff, do you have a savings tip for us?
My savings tip is start early. The key to savings is compound interest. And the earlier you can start your saving plan, the earlier or the quicker you can build up your savings through time. Because it builds rapidly through time. So if you leave it late in life to start saving, you're going to find it a lot more difficult. But if you start early, it'll be a lot easier.
Wish you were there 20 years ago to give me that advice, Shane, because silly me kept a lot of my money in a transaction account, earning basically zero interest for that entire time until I was in my mid-20s when I discovered, oh, wow, you can actually get a bit of money simply by keeping your money in a savings account. But look where we are now. Come a long way. So getting on to, the big matter of the day, the RBA rate cut. Now, obviously, there was no surprise in the decision. Everyone largely expected this rate cut to happen, 25 basis points. But were there any surprises in the language that was used in both the accompanying statement and the governor's conference?
Yeah, you're certainly right. No great surprises in the move to cut by 25 basis points. That had been almost 100% factored in by the money markets, and most economists expected that. But the language from the Reserve Bank was radically different than most expected. It was what we economists call dovish. In fact, a lot more dovish than you saw back in February or the April meetings. After the February meeting, it almost looked like it could be a one and done, that the Reserve Bank was very cautious on the outlook, still worried about inflation, not too concerned about tariffs and those sorts of things, whereas by the latest meeting, Governor Bullock had become a lot more concerned about the impact of the tariffs, the flow through of that to unemployment, and at the same time, they'd become more confident about inflation. So far more dovish language, and we economists use this term dovish and hawkish quite a bit. Hawkish refers to a language which is sort of inclined to raise rates. Dovish means inclined to cut rates, and that's what we got a lot of from the Reserve Bank governor and the Reserve Bank commentary this week.
Yeah, for sure, Shane. Now, it seems like there's kind of two factors happening right now. The economy in Australia, by and large, is still performing well. You know, there's a lot of people who are looking for work and find work still. That's been one of the key surprises, you know, coming out of COVID and all these rate rises. But then in the US, there's all this Trump tariff talk and uncertainties abroad as well. What's really driving this dovish tilt, as you put it?
Well, to be honest with you, I think the Reserve Bank probably would have got there anyway. They probably would have cut anyway were it not for Donald Trump, because we have got inflation down. And on the Reserve Bank's own forecast, they now see inflation stuck at around 2.6%, which effectively is the midpoint of the 2 to 3% target range for the next couple of years. In fact, all of the period for which they do forecasts. So they probably would have cut anyway. But I think the big change since February, when they first cut, is that Donald Trump's tariffs have ramped up a lot. In fact, as Governor Bullock said, it's a bit of a roller coaster ride, depending on which day you look at it. So we initially saw a massive ramp up in tariffs going into the so-called Liberation Day announcement on April the 2nd. Then since then, there's been a back down. But if you were told back in February that tariffs would get to where they are now, that's after all the back downs, you'd still be a bit shocked. The average tariff going into the US at one point would have got over 30%. On the back of the Chinese tariffs, 145%, and tariffs to other countries. Now it's, with the pauses, it's probably around 14%. But that's still about 5 times what it was last year going into the US. The reason the Reserve and other economists are worried about that is quite simple, and that is that tariffs disrupt economic activity and the free flow of trade around the world. So we've got a very open and global economy, not perfectly open, but pretty open at present. Donald Trump imposing these tariffs will disrupt supply chains, make life very confusing for businesses deciding where to invest, and make it harder for consumers because prices into the US will go up. That in turn will depress the US economy and have a flow-on effect to other economies, particularly our trading partners in Asia. And that, of course, has a flow-on back to us, even though we on our own don't export a lot to the US. So this is going to be a drag on our economy. The debate is about how much. But given those risks around that, it points to more rate cuts ahead.
Shane, can you say that, quite confidently that perhaps the inflation dragon has finally been slain and, the RBA has pulled off the soft landing it's so desired?
Well, I wouldn't quite say mission accomplished yet, and I don't think the Reserve Bank wants to say that. I think for those of us who've been around for a while, you may remember the images of George W. Bush on the aircraft carrier in relation to Iraq more than 20 years ago now, saying that they'd done their job. And then, of course, the conflict in the Middle East and Iraq went on for a long time after that. So it could well be the same. It's premature to say mission accomplished, but for all intents and purposes, we've got inflation down from around 8%. It's currently on headline inflation 2.4%. Underlying inflation, which strips out the impact of energy rebates, is 2.9%. So it's back in the target range and looks like it'll probably come down further. So it's right for the Reserve Bank to feel feel more confident about things on the inflation front and to start to look at other things. And the big worry at present is what the impact of Donald Trump's tariffs will be on the economy, on unemployment. So in other words, they're pivoting a little bit away from worries about inflation towards worries about higher unemployment. So I wouldn't quite say that it's mission accomplished, but we're pretty close to it.
Yeah. Now, Shane, we'll move back home a little bit and into the hip pockets of everyday Aussies. The sort of talk on the street is that like what are people going to do with their home loan repayments? Are they going to lower them and then pocket the difference? Are they going to keep them at the same rate? And just anecdotally, we've been discussing with different people, they're actually going to pocket this one and maybe put it towards groceries or just the everyday essentials, whereas it seemed a bit different in February. Can you just explain, why that might be? Can you just explain the sort of lag in interest rate rises? Even though rates are coming down now, people are still feeling the pinch. Can you just explain that for us?
Well, the pinch comes basically from the fact that over the since December 2020, prices in Australia are up about 20% on average. I know people will say, well, my insurance bill is up 40% or my grocery bill is up 35%. But on average, prices in Australia, as measured by the CPI, are up 20%, wages are up 15%. So real wages have gone backwards to the tune of 5% over that whole period. Now, we are starting to see wages growth pick up relative to inflation. We're starting to see real wages growth, but you've still got this mismatch as measured over the last few years. People are still behind, and so they're still feeling the pinch. And I think that's why when faced with interest rate cuts, it takes pressure off households who are really stretched in terms of their mortgages. So that's good news. But are people going to go on a spending bender, so to speak, and spend lots of money? Probably not. I think a lot of people will use it to maybe pay down the mortgage faster. There will be perhaps some increase in spending, but the cost of necessities have also gone up, so that'll eat up some of it. And so I don't expect it going to have a huge immediate boost to economic growth. People will feel more relaxed. There'll be less people potentially defaulting on their loans or being forced to sell their house. But I don't think we're going to see a huge pickup in spending. I mean, there is good news out there, but you just got to bear in mind that if you've got an average mortgage of $660,000 from where we were back in early 2022, after the 13 rate hikes to November 2022, your annual payments on that mortgage would have gone up by about $16,000 to $17,000. So now, with the two rate cuts, assuming the banks pass the mortgage rate cut on in full to you, you'll be saving about $2,500. So you're better off than you were back in January, but in terms of mortgage payments, they're still well up from where they were back in April of 2022 before the rate hike started, simply because we've only had 2 cuts and there was 13 hikes in a simplistic context. So yes, a bit more confidence, a bit more spending, but not going to cause a boom, I don't think.
Yeah, me personally, I can certainly attest to what you're saying there, Shane. I'm not going out and dancing in the streets with this rate cut. It really just feels like it's offsetting, the increase in my grocery bill, my insurances bill. So it's really just don't get me wrong, I'm relieved, I'm happy that I'm getting a rate cut, but it's not going to send me, booking summer European holidays and whatnot. But perhaps maybe if I get a few more rate cuts, Shane, and so that's going to be my next question, which will probably tell us, how much of a dove or a hawk you are. But do you see many more rate cuts happening this year?
At least 2, possibly 3. The cash rate is currently 3.85%. I think it's on its way to 3.1%, and the debate is about the timing of when that will happen. The money markets are putting about a 60% probability of another cut in July, and another rate cut is fully priced in by the time of the August meeting, which I think is about August the 12th or thereabouts. So we'll get one, I think, at least by August, possibly in July. Then we'll probably have another one after that in maybe November, and then maybe one more after that. So adding up to about 3 cuts. So I think we are on our way lower. The Reserve Bank, there's a little bit of an inkling of that in the Reserve Bank commentary, that they still think that monetary policy is tight, that interest rates are restrictive, a bit less than they used to be, but still restrictive. There's a graph in the Reserve Bank statement of monetary policy out following their meeting, which shows that their assessment of the neutral rate, or the midpoint, is about 2.8%. So if we had the cash rate at 2.8%, then monetary policy would be neither stimulating or slowing the economy, whereas we're currently at 3.85%, so we're well above the 2.8% neutral level. So I think we'll see more cuts to get us to that level. Obviously, to get to 2.8% would require almost 4 cuts from where we are at present. But I wouldn't go that far, but I do think we're going to see another 3.
There we go. Some potential home loan rate relief on the way for those with a mortgage, and maybe the glory days of savings account rates are over for now anyway. But Shane Oliver, thanks so much for joining us on the Savings Tip Jar podcast. We appreciate your insights.
Thanks, Harrison. Thanks, Dominic. Great to speak to you.
Thanks, Shane. Likewise. Cheers.
See ya.
Awesome.
Bye.
Alrighty.